What if I told you that in less than 48 hours, a 200 plus billion-dollar bank serving some of the most sophisticated investors in the world simply stopped existing? Not in 2008, not during a global recession, but in 2023, its name was Silicon Valley Bank, the bank of startups, the bank of venture capital, the bank of innovation, and it collapsed faster than Lehman Brothers. Not because of toxic subprime mortgages, not because of fraud, but because of something quieter: interest rates, concentration risk, and digital panic. By Thursday afternoon, it was stable. By Friday morning, it was seized by regulators. 48 hours. So the real question isn't just how it failed. The real question is this: how does a bank serving the smartest people in tech fail so quickly, in plain sight? To answer that, we need to understand what changed after 2008 and what didn't. To understand the collapse, you first need to understand what made Silicon Valley Bank unique. Founded in 1983, SVB wasn't a typical retail bank. It didn't focus on mortgages. It didn't build branches on every corner. It didn't compete for everyday consumers. It focused on one ecosystem: startups, venture capital firms, founders, technology companies. If you launched a SaaS company in California, there was a high probability you banked with SVB. Over time, the bank became deeply embedded in the innovation economy. It provided banking services, venture debt, treasury management, networking within venture capital circles. By 2021, SVB had become the 16th largest bank in the United States. Its clients weren't random households. They were highly connected companies, and that detail would matter later. Because when your customer base is concentrated, your risk is concentrated too. In 2020, the pandemic reshaped global markets. The Federal Reserve slashed interest rates to near zero. Liquidity flooded the system. Tech stocks surged. Venture capital funding exploded. Startups raised unprecedented amounts of money. And where did much of that capital end up? Deposited at Silicon Valley Bank. Between 2020 and 2021, SVB's deposits more than doubled. This created a new problem. Banks must invest deposits, but safe assets at the time, like U.S. Treasuries, were yielding very little. So SVB bought long-term Treasury bonds and mortgage-backed securities. They were considered safe, extremely safe, but they carried one critical risk: interest rate risk. If rates rise, bond prices fall, and the longer the bond maturity, the larger the price drop. At the time, inflation seemed temporary. Most institutions believed rates would remain low. But by 2022, inflation surged. The Federal Reserve began raising rates aggressively, one of the fastest tightening cycles in modern history. And suddenly, the bonds SVB purchased at low yields were worth far less in market value. On paper, the bank had billions in unrealized losses, but unrealized losses are survivable unless something forces you to sell. Here is where the story becomes systemic. Most traditional banks have diversified deposit bases: consumers, small businesses, regional clients. SVB did not. Its depositors were overwhelmingly tech startups, venture capital-backed firms, companies burning cash. And by 2022, the tech funding environment changed. Venture capital slowed. Startups stopped raising fresh capital, which meant they began spending their deposits. Withdrawals increased. Now remember, SVB had invested heavily in long-duration bonds. To meet withdrawals, the bank needed liquidity. On March 8, 2023, SVB announced it had sold $21 billion in securities at a $1.8 billion loss. It also announced plans to raise capital. That announcement triggered something dangerous, because in banking, confidence is everything. And when you publicly announce losses and a capital raise, you signal vulnerability. In previous decades, panic spread slowly. But in 2023, panic spreads on Twitter. Venture capitalists began advising portfolio companies to withdraw funds. Group chats lit up. Slack channels exploded. Founders wired money out all at once, not days, not weeks, hours. Thursday, March 9th, customers attempted to withdraw $42 billion in a single day. That is not a typo. $42 billion in one day. This was one of the largest bank runs in U.S. history, but unlike 1930, no one stood in line, no physical panic, just digital transfers, a few clicks, a few confirmations, and billions disappeared from the balance sheet. By Friday morning, March 10th, regulators stepped in. The Federal Deposit Insurance Corporation seized the bank. Silicon Valley Bank was shut down in less than 48 hours. The speed changed everything. This was the first major social media-driven bank run, the first modern, digitally accelerated liquidity collapse. And it raised an uncomfortable question. Are banks stable in a world where panic moves at internet speed? Unlike the collapse of Lehman Brothers, SVB did not fail because of toxic credit. Its assets were largely government-backed. The problem was duration mismatch. Short-term deposits, long-term bonds. When interest rates rose rapidly, the mismatch became lethal. After 2008, regulators focused heavily on credit risk, but interest rate risk received less attention. Another factor made this unique. More than 90% of SVB's deposits were uninsured, above the FDIC $250,000 limit. When depositors realized this, fear intensified. By Sunday, March 12th, U.S. regulators announced all depositors would be made whole, even uninsured ones. The decision prevented broader contagion, but it also reignited debate about moral hazard. Are we truly prepared for digital bank runs, or did we just prevent one domino from falling? Silicon Valley Bank did not collapse because of reckless gambling. It collapsed because of concentration, duration risk, rapid rate hikes, coordinated digital withdrawals. But underneath those mechanics lies something familiar. Banking is built on confidence. When depositors believe their money is safe, the system functions smoothly. When that belief fractures, the system destabilizes. In 2008, we learned that leverage amplifies fragility. In 2023, we learned that speed amplifies fragility. Financial systems are more efficient than ever, more connected than ever, more digital than ever, which also means they are more synchronized than ever. And synchronization makes panic exponential. Silicon Valley Bank collapsed in 48 hours, but the structural vulnerabilities took years to build. And the question that lingers is not whether this was the last rapid collapse. The question is, in a hyper-connected financial system, how fast can the next one happen? Because in modern banking, liquidity is digital, but fear still spreads the same way.